My name is Romano Segali. I'm an architect and also a business analyst. Today we're going to be talking about the Nigerian economy and how it got to its present situation. I want to implore you to listen attentively and carefully. But before we proceed, I want to borrow a quote from Hans Rosling, which states that data allows your political judgment to be based on facts to the extent that numbers describe reality. Why data? Data tells you the historical trends of the past, the trends of what is going on right now, and the likelihood of the trends of what will happen in the future. President Buhari has consistently been blamed for the recession, the massive outflow of FDI from Nigeria, and the limited inflow of FDI. But the truth is, data states otherwise. In the book, The End of Poverty, Professor Jeffrey Sachs states that to understand economics, you must compare it to clinical medicine, whereby the historical past of an ailment is pulled out to treat the present so that you can also prevent the ailment from happening in the future. The simple answer to Nigeria's economic woes and progress is this. One president put the factors and balance sheet of the country in the green, and these are the things that attract FDI. Immediately he did that, FDI flooded the country. And another president came in, reversed those factors, and put the balance sheet of the country in the red. And immediately FDI saw that, they started fleeing the country. And then the last president is now trying to reverse back to status quo. Remember, of the 5 factors that make up the aggregate demand, that's your GDP, consumer spending, investment, government spending, import and export. Investment is the most volatile. Why? Because once investors start pulling out their funds out of your economy, it could lead to a total economic collapse. For foreign investors to either come into your economy or leave, there are 3 preliminary factors they first consider. 1. Stability. Political, regional, and state. Regional being that whatever happens in a neighboring country has the potential of spilling over into your country. Second is the return on investment. Third is the country's balance sheet, taking into consideration assets, equity, and liabilities. And this is where your foreign reserve plays a critical role. When Obasanjo took over as president in 1999, Nigeria had 4 billion in its foreign reserve with a huge debt profile. But by the end of 1999, foreign reserve had been increased to 5.65 billion, with FDI coming in that year at 1 billion. By 2005, foreign reserve had been increased to 28.6 billion, with FDI coming in that year at 4.98 billion. By 2007, foreign reserve had been increased to 52 billion, with FDI increasing to 6 billion that year. By 2008, foreign reserve had increased to 54 billion, with FDI coming in that year standing at 8.2 billion. Between 1999 and 2008, foreign reserve increased by 47.6 billion, that is 845%, and FDI marginal inflow of 7.2 billion increase, that is 716%. The trend you want to see here is that as the foreign reserve was increasing, the FDI was also increasing. So what did Obasanjo do? Obasanjo was increasing our foreign reserve, that is increasing the asset base of the country. He was paying off our debts. That means he was reducing liabilities. And external earnings was 43% of our GDP in 2006. That is, our revenue income was good. And also the fourth thing he did was that he ensured both state and regional stability. Remember, there was UDI, there was JAWS and other pockets of insurgencies in the north. But what did he do? He crushed them all. Why? Because he understood the essence and strategic importance of both state and regional stability to economic growth. So what did this do for Nigeria? It created a good balance sheet for the country. And what is a balance sheet? The balance sheet shows the financial position of a company, a country, or even an individual on a specific date, taking into account assets, liabilities, and shareholders' equity. Suppose you want to invest or you want to buy a company, right? The first thing you do is to ask for the balance sheet. You look at the total assets vis-a-vis the total liabilities. If the total assets exceeds the total liabilities, then you know that the company is solvent. It can pay its debt and also service its debt. But if the total liabilities exceeds the total assets, then the company is in trouble. It is not a company where you want to invest. More so, when you now take a look at the income statement and find out that the company is generating good revenue, two things might be happening here. It is either the company is being mismanaged or the funds are being embezzled. So in 2006, the credit rating institutions, Standard & Poor, that is S&P, Fitch, and Moody's started rating Nigeria. This further increased investors' confidence in the economy. And between the foreign reserve and the excess crude oil account, the ECA, Nigeria had over 102 billion, which represented its liquid assets at that time. Looking at the above graph, you see that from 2004 to 2009, there was sharp increase in the foreign direct investment net inflow into the country. This represented the Obasanjo and the Yaradua years. As the foreign reserve increased, so did the net inflow of foreign direct investment increase. So what is the strategic importance of the foreign reserve? 1, it shows that the country can pay its debt. 2, as the foreign reserve increases, it defends the naira and the naira starts to appreciate. What do I mean? In 2004, when Soludo became governor of Central Bank, the dollar sold for 147 naira. And by 2009, when he was leaving, the same dollar was now selling for 117 naira. It had appreciated by 30 naira against the dollars. So if an investor had brought in $500 million in 2004, that same $500 million would be worth $628.3 million in 2009. That is $128.3 million in gains from appreciation and not from operations. These are what investors look out for before they want to bring their money into your economy. So in 2009, seeing the progress in Nigeria's economy, S&P upgraded Nigeria's credit ratings, and this further boosted investors' confidence in the Nigerian economy, increasing FDI to 8.55 billion that year. In 2010, Goodluck Jonathan became president and started doing the direct opposite of what Obasanjo had done. By 2011, the foreign reserve was being depleted. What this means is that the foreign reserve, the assets of the country, was being reduced. And then they started borrowing, increasing the debt, which meant that the liabilities of the country started increasing. And then income from crude was at an average of $110 per barrel. What this meant was that there was good revenue, income revenue coming in, but the assets of the country was not being increased. So what were the implications of Jonathan's actions? 1, the balance sheet of the country went into reds. And as the balance sheet went into reds, in 2012, the international credit rating agencies downgraded Nigeria's credit ratings. And as Nigeria's credit ratings were being downgraded, this further eroded investors' confidence in the Nigerian economy. And FDI started dropping from 2012, while companies started moving funds out from 2013. From the graph, you can see the sharp decrease between 2004 and 2006, when the Obasanjo administration paid off the debt, and then the sharp and monumental increase between 2009 and 2013, when the Jonathan administration increased the debt. In fact, FDI started reducing in Nigeria since 2012. In 2011, FDI reached its all-time high of 8.8 billion that year. But by 2012, when the international credit rating agencies downgraded Nigeria's credit ratings, FDI started dropping. In 2012, it had dropped to 7 billion. And by 2013, it had further dropped to 5.5 billion. By 2014, it had dropped to 4.6 billion. And by 2015, with only $31 billion left in the foreign reserve, FDI that came in that year stood at 3.1 billion. Between 2011 and 2015, the foreign reserve reduced by 31 billion, that is 50%. The excess crude oil account reduced by about 95%, and the foreign direct investments into Nigeria reduced by 65%. The trend you want to see here is this. As Nigeria's foreign reserve was being depleted and the credit ratings downgraded, so was FDI reducing. And then the question we want to ask, if the economy was booming as it was claimed to be, why was FDI reducing? Why were investors staying away? Looking at the above graph, it shows a sharp decrease from 2011 to 2015, which also represent the Jonathan years. As the Foreign reserve was being depleted and credit ratings downgraded, so was FDI reducing. Is debt bad? No, debt is not bad. But the difference is this. We're going to take China as an example. If you go into the International Credit Rating Agency's website, you will see that China is graded A-, A+, A2, A1. Why? But China owes 27 trillion in debt and has 3 trillion in its foreign reserve, a ratio of 9:1. What is China doing? China borrows and converts its liabilities to fixed assets. China is investing in highways, bridges, rail lines, airports, seaports, infrastructures, etc. So what China does is this: it borrows, converts those liabilities into fixed assets. So at the end of the day, the total asset cancels out the total liability. But some may ask, but Nigeria has airports, we have highways, we have some bridges, right? The question you should ask is this: when were they built? Some of them were built 30, 40, or even 60 years ago. So depreciation have wiped out the amount that is supposed to be allocated to them. Why the reducing inflow and massive outflow of funds? It was simple. The 3 preliminary factors FDI considered before coming into your country were in the reds. Companies had seen it coming since 2011. First, Boko Haram had metamorphosized from being a state problem into a regional problem. It had spread into Niger Republic, Chad, and the Cameroon. Second, the country's balance sheet was going into the red. The country's liabilities was now increasing while assets was reducing. And third, investments will depreciate because Naira cannot be defended due to the depleted foreign reserve. What do I mean? Exactly the opposite of what happened between 2004 and 2009. When investors made profits from appreciation of the Naira was going to happen this time around. They will lose from depreciation. We must understand that companies perform either quarterly, biannual, or annual review of markets and industries they operate in. They must have seen these things coming from between 2011 and 2012 and started pulling out and refusing to come into the economy, and also pulling their funds out from 2013. In fact, in February 2015, the Vanguard newspapers reported capital flight, how companies pulled out 22.1 billion in 5 weeks in 2014. This trend has been going on since 2013 without anyone noticing it. So, with the massive outflow of dollars, why did the Naira remain stable all this while? 4 things were happening, and were happening simultaneously. 1. The 40 billion excess crude oil funds found its way into the economy. Second, the Jonathan administration borrowed 21.8 billion, which was used for recurrent expenditures. These funds also found their way into the economy. Third, between 30 to 40 billion dollars that was generated from excess crude oil sales that was never paid into the foreign reserve also found its way into the economy. And fourth, the foreign reserve was depleted to the tune of 31 billion. This fund also found its way into the economy. So all these funds found their way into the economy, creating a massive supply that eventually met demand. What is Buhari doing? It is simple. He's simply restoring the 3 factors that attract FDI. First, he's been able to crush Boko Haram, restoring stability to both state and regional. If not 100%, at least he's been able to restore stability to 90–95%. And if you think this is not important, there are business opportunities in Libya, Yemen, Somalia, and Syria. Perhaps you can invest in these countries. Second, he has started increasing the foreign reserve. And as the foreign reserve is shored up, assets increases and supersedes liabilities. And as assets supersede liabilities, the balance sheet moves into the green. And as the balance sheet moves into the green, the credit rating agencies can upgrade Nigeria's credit ratings. And this will further boost investors' confidence in the economy and bring in their money. Remember, you cannot fool investors. These are the factors they look at. If you like, go park 50, 80, or 100 private jets on the tarmac and tell the world that you've made 20 or 40 or 50 billionaires. If these factors are not in place, investors will not come in. Those blaming President Buhari must look further. Why? Because the president said it is no longer business as usual. So militants have gone around blowing up pipelines and have reduced the country's capacity from 2.2 million barrels a day to 1.4. What that means is this: with the reduced capacity and the reduced oil price, companies might not be able to break even. And if they cannot break even, they will move their funds out. And that's exactly what has been going on. Guess what? Fracking is what is trending right now. A lot of companies are moving back to the US and investing in fracking, where they know that if they sign up for 2, 3, or 4 million barrels of crude oil a day, they are surely going to get it. So if we make the environment unproductive and unprofitable for them, they are surely going to move their funds out. This is my advice to President Buhari. Diversify the economy. Why? Because the future of crude is bleak. A lot of companies are investing billions of dollars in the technology to better the processes and procedures of fracking. The reason why a barrel of crude oil sells for less than $60 right now is because fracking gets a barrel of crude oil into the market for $60. So what happens if tomorrow the processes and procedures are bettered and fracking is able to deliver a barrel of crude oil into the international market for $50, $40, or $30? That means that we will continue to reduce our prices, and it is a future disaster for us. My advice to Nigerians is this: when there's a downturn in the economy, it doesn't just stop because of the change of leadership. It will continue until it reaches its rock bottom before it starts to climb again. Remember, in 2009, when President Obama took over office as president, it took about 2-3 years before the American economy became stable and started growing again. And it wasn't until mid-2016 that the Treasury Department finally said that Obama had completely turned the US economy around. It took him 8 years and a $10 trillion debt to be able to do that. Now, my question is this. We had a finance minister and a coordinating minister of the economy that came from a world financial institution where these factors are used to grade individuals, companies, corporations, and countries. Yet, she did the direct opposite in Nigeria. Now, if we want FDIs, we have to play by the rules of the game, and these are the rules. I have done an extensive research on this. Go to the blog, Leadership and Advancement. The title of the article is The Dollar Recession, Obasanjo, Jonathan, and Buhari, The Unknown Truth Behind the Economy. Let us arm ourselves with the knowledge we need before criticizing the government. Thank you.